Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling intercompany transactions concept. And this is an extension of General Ledger. And this is lesson 61. Victor, please walk us through.
Thank you, Bob, for the introduction. And welcome to lesson 61 of our Oracle Financials Functional Training series. Like Bob said, today we are going to look at intercompany transactions. This is a concept that we have covered as we were looking at the topic of consolidation in GL. So it's something that isn't very new, but we are going to add some more nuance to it. So, like I said, we have an idea of what intercompany transactions are. And as you can see, what I have put in the heading here, we are going to talk about intercompany and intracompany transactions. Okay. So when we were discussing intercompany as part of consolidation, we didn't differentiate between intercompany and intracompany because it wasn't really necessary at that point. But as we cover intercompany transactions in detail, we are going to see the difference between intercompany transactions and intercompany transactions because there is a difference. However, before we introduce that nuance and we differentiate between these two, the intercompany and intracompany, we are going to use the term intercompany for now to refer to both of them. So we are going to use the term intercompany to reference both intracompany and intercompany without the difference. But don't worry, we are going to understand soon what the difference between the two terms is. However, so as an introduction, what should we understand intercompany transaction to be? So this definition that I'm giving at the moment, like I said, covers both intercompany and intracompany. So right now, we should understand intercompany transactions as transactions that occur between two entities under the same corporate enterprise. Okay. So any transaction that occurs between two entities that are part of the same corporate enterprise, we refer to it as an intercompany transaction. So remember, as we said when we were doing consolidation, a company will trade with external entities, clients, maybe who they are selling their goods or services to, or will have vendors or suppliers from whom they purchase goods and services. So those types of transactions are external transactions. Okay, the company is dealing with external entities, but at some point maybe there might be a requirement to trade or to conduct transactions with other components that fall under the same corporate entity. So that is what we call an intercompany transaction. And that is what I have tried to represent on this slide. So these two companies fall under the same enterprise, and when they enter into a transaction, then we call that transaction an intercompany transaction. So again, going back to the topic of consolidation, this is basically what we did when we were doing our consolidation. We have we have two companies, all right, and they enter into a transaction with each other, all right. However, at the end of the period or whenever they do their reporting, these two companies are subsidiaries of a larger parent company, okay? And this parent company wants to produce consolidated reports, all right? So what happens is that we transfer, we do a data transfer of the financial information for these two companies, which are subsidiaries, to the parent company ledger, or we can have a separate consolidated ledger where we transfer both the transactions for the subsidiaries and the transaction for the parent company, and then we produce the consolidated financial reports. All right. The other thing that we talked about when doing consolidation is the need to do elimination of intercompany transactions in the consolidated ledger. Why do we do this? Because basically these are what we may call, like, you can say it's like an in-house transaction. And if these kind of transactions appear, or these numbers appear on the financial reports, then it means the reports are erroneous, right? Maybe they might be overstated or understated, and that can get the company, the parent company, into legal trouble, because basically you're reporting inaccurate numbers to whatever entities you're supposed to produce these reports for. The other thing that we talked about when doing consolidation and dealing with these intercompany transactions is how to identify intercompany transactions. And we looked at two ways. One is to use different accounts, separate accounts from the accounts that would be used if the transaction is conducted with an external entity. So we created intercompany accounts. If you can remember, we created intercompany revenues, we created intercompany payables, intercompany expenses, and so on. And what this does is that when we do the data transfer to the consolidated ledger, then we are able to understand, we are able to identify which transactions we want to eliminate, because we need to eliminate the intercompany transactions. The other way to identify intercompany transactions that we discussed is by creating a chart of accounts that has an intercompany segment, so that also we are able to identify, once we have done the data transfer to the consolidated ledger, we are able to identify which transactions we need to eliminate. So we talked about all these concepts. We talked about the creating elimination journals using the elimination set. We also talked about how we can use an elimination company to produce the elimination journals. So we are going to look at these topics again and more in depth, but we just wanted to do a refresher of this topic of intercompany transactions. And if you have forgotten, maybe you can go and refresh and watch those videos on consolidation. Okay, so let's go on with intercompany transactions. Again, remember, at this point, we are still not yet differentiating between intercompany transactions and intracompany. So at this point, we are just using the term intercompany transactions to refer to both kinds of transactions, intercompany and intracompany. So let's put the differences between those two terms in the back burner for now and just use intercompany as the overarching term. So we are going to look at examples of intercompany transactions that these two companies belonging to the same corporate enterprise might enter into, right? And the kind of accounting that might be produced by these transactions, okay? So let's start with this first example, which is a sales and purchase transaction. So we have these two companies, company 01 and company 02. They belong to the same enterprise. And in this transaction, what is happening? In this transaction, if you look at the journal lines that might be produced, company 01 is selling a good or service to company 02, okay? How do we know this? Because according to the accounting pattern that we have followed, account 4,000 is a revenue account, 1,200 is a receivable account, 5,000 is an expense, and 2,000 is a payables account, right? So in this kind of transaction, what happens? Company 1 sells a good or a service to company 2. So company 1 will generate some revenue, all right? And then since this is not a cash transaction, we debit the receivables, all right? So company 2 owes company 1 some money. On the other hand, what happens in the books of company 02? Company 02 incurs an expense, right? Because it's purchasing a good or a service. So we debit the expense account and we increase company's 2 liabilities because it owes company 01 some money for the goods that it has bought, all right? So that's an example of an intercompany transaction, which is a sales and purchase transaction. Let's look at another example here. And this example is an expense allocation, all right? So what do we mean by an expense allocation? Perhaps company 01 incurred the total expense for a certain transaction, but it now wants to reallocate this expense to company 02. All right, so what is the accounting that might be produced by such a transaction? So we can see here that because company 1 had incurred the expense already, now when it wants to reallocate this expense to company 02, it will credit its expense, which means it's reducing its expense, and then it is expecting to be paid by company 2, right? So it will debit the receivables here. So the receivables will increase. On company 2, on the other hand, its expense will increase because this expense has been reallocated from company 01 to company 02, and then its liabilities will increase. We are crediting its liabilities because now it owes company 01 some money, all right, for the expense that company 01 incurred. So that's another example of an intercompany transaction that may happen between these two companies. Let's look at this other example, which is a borrowing and lending example, okay? So what might happen in this kind of transaction? Company 1 might lend some money to company 2, or if you look at it from company 02's expenses perspective, company 2 is borrowing some money from company 01, okay? So what will happen is that company 1 will credit its cash, okay, because it's reducing cash and transferring it to company 02. All right, so company 02 cash position will increase. That means we debit the cash account for company 02. But on the other hand, it means that at some point, this company 02, it owes company 1 that money, right? So its liabilities have also increased because it will have to pay back company 1 this money. And on the other hand, the company 1's receivables have also increased because it's owed money by company 2. So this is another example of an intercompany transaction that might take place between these two companies which belong to this enterprise. So, of course, we might have other examples of intercompany transactions. You can have maybe something instead of one company purchasing a good or a service, then it's purchasing an asset, right? Or maybe it's purchasing some inventory. So all those are kinds of intercompany transactions that might occur between these two companies. So with those examples that we have looked at, we should have noticed a trend, all right? So let's go back to the first transaction. So the trend you should have noticed is what? How in all the transactions, the receivables and payables accounts are always involved, all right? So we are debiting the receivables account here and crediting the payables account here, all right? In this transaction, the expense allocation, we are also debiting receivables and crediting payables here. Again, in this transaction for borrowing and lending, we are debiting receivables and crediting payables, okay? So this is a pattern that we will see in these intercompany transactions, all right? So this is something that you should keep in mind, and we will see why as we go in deeper to this topic of intercompany transactions. So just keep that concept or that idea at the back of your head, how the receivables and the payables account are always involved, all right? And how we are debiting one of them and we are crediting the other. And this is going to come in handy when we talk about intracompany balancing, all right? Which is maybe the main idea behind this topic of intercompany transactions, okay? So just keep that idea at the back of your head, and we are going to see where it falls into place as we continue with this topic of intercompany transactions. So, okay. So as we have said, in those examples that we were giving, we talked about intercompany as an overarching term, okay, that covers both intercompany and intracompany transactions. But we know that we have intercompany and intracompany transaction, and there's a difference. So in order to understand the difference between intercompany and intracompany, we first need to understand the concept of a legal entity. I'm not sure whether we have mentioned the term legal entity, but maybe when we were creating our ledger, and we didn't do anything concerning legal entity when we were creating our primary ledger. But anyway, let's talk about it now. So what is a legal entity? So basically, a legal entity is an entity that's recognized by the law. And in the corporate world, it can be what? It can be private company, right? It can be a privately held company. Another kind of organization, it can be a government agency, or maybe in some places where they're called parastatals or something like that. It can be a publicly held company, a publicly traded company, or it can be a partnerships, like in the US, a lot of maybe law firms or consulting firms can be partnerships. So basically, a legal entity is an entity that is recognized by the law. And perhaps when we think about a legal entity in what we are talking about in Oracle, what comes into mind basically is just a company, all right? So maybe when you talk about legal entity, you can think about it as a company. A legal entity is able to do what? Is able to employ people. It is able to buy and own and also sell assets, all right? So basically, a legal entity is granted by the law the ability to enter into transactions with different entities in the market. So it can employ people, it can enter into trade with other companies, etc. However, when the legal entity is granted these rights, it is also placed upon it responsibilities. All right. So a company has to comply with certain laws, maybe employment laws, things like minimum wage or something like that. It also has to produce financial reports at specified times or at specified periods, and there are agencies to which it has to produce these reports to. So basically what we are saying is that a legal entity has rights and it also has responsibilities. Okay? So that's what companies have. They have rights and responsibility. There are things which they are allowed by the law to do, and there are also responsibilities that they have to meet according to the various laws. And these laws might differ depending on the jurisdiction, maybe depending on, like if it's in the US, depending on the state, or on a country level, depending on the country. So now we know what a legal entity is, all right? So now that we know what a legal entity is, we can be able to differentiate between an intercompany and intracompany transaction. So according to in Oracle, an intercompany transaction is one that occurs between two legal entities. Okay? So if a transaction occurs between two maybe companies that are recognized by the law as legal entities, then that's an intercompany transaction. However, if a transaction occurs between two entities that are under a single legal entity, all right, or two components under a single legal entity, then we refer to that transaction as an intra-company transaction, okay? So intra specifies more like internal. It's more internal than inter, all right? So that's the difference between That's the nuance between intercompany and intracompany transactions in Oracle. So now let's go back to our examples. So if these two companies, they are under the same enterprise, all right, but if these two companies are registered as separate legal entities, then this remains an intercompany transaction, right? However, if this enterprise is the one that's registered as a legal entity, and these two companies are just components under this legal entity, and they enter into a transaction, then this will be an intra-company transaction, all right? So that's the difference between an intercompany transaction and an intra-company transaction. So let's just talk about it a bit more, and maybe let's use the companies that we have been using, the Maskani, okay? So for example, under our setup, we have Maskani property management, and we have Maskani developers, okay? So now, Oracle, it helps us to like represent what is happening in the real world in our implementation, okay? So now, for example, let's say this our Maskani enterprise. It started as a small business, okay? So whoever started it called it Maskani Enterprises, and let's assume that they registered it as a company. So it's a legal entity, Maskani Enterprises. However, Maskani Enterprises has two lines of business, okay? So one line of business might be the property management, and the other line of business is development, like real estate development, okay? So in a sense, in that case, we can look at even as Maskani property management or Maskani developers. We've been calling both of them companies, but we can now think about them as just basically like different operations or different lines of business or different divisions, okay? But they are under one enterprise called Maskani Enterprise, okay? So assuming this is Maskani developers and this is Maskani property management, a more accurate term would not be company, but rather maybe business line or operation, okay? So here, Maskani Enterprise is the legal entity, and it has two lines of business, okay? But they are all under Maskani Enterprise. So if Maskani developers enters into a transaction with Maskani property management, right, then that's an intra-company transaction, okay? Because it's two components of us under a legal entity that have entered into a transaction, okay? And these components can actually, they don't have to be like just lines of business. They can be different components under a legal entity. It can be a cost center. It can be maybe something like a warehouse. Maybe one warehouse is transferring an asset to another one, right? Maybe one warehouse is transferring a machine to another one. That's a transfer of an asset, okay? So that can be an intra-company transaction because those two components are under the same legal entity, okay? So now assume that because business is really good, Maskani Enterprise grows and it becomes a real big operation, and both lines of business, they expand really huge. Maybe if they're based in the US, they expand to other states and all that. So it becomes a really big company. Now, for the sake of optimization of operations, right? You might want to split these two companies, okay? Because they have grown really big, and you need like more more people to manage. So at the beginning, maybe you had this enterprise, it had something like one CEO or maybe one board of directors or something like that. But because both these two companies have grown really big, then Maskani Enterprises decides to register these two lines of business as separate companies. Okay, so maybe they register Maskani Developers as one company that deals specifically with real estate development, and then they register Maskani Property Management as another company that deals only specifically with managing properties for other business. Okay. Once they do that, maybe they'll have to appoint different CEOs for each company. So Maskani Property Management will have its own CEO, and Maskani Development will have its own CEO. And maybe even they'll change this Maskani Enterprise and change it to Maskani Group of Companies, because now we have two separate legal entities. And this also can be a legal entities, but it can be a legal entity now, the Maskani Group of Companies, but it's basically like a holding company for these other subsidiaries under it. You can even think of now, remember how we did consolidation from Getao Enterprise to Maskani, okay? Maybe even you can think about it as Maskani has grown so much, it's even now expanding to other countries. So it goes to Kenya and purchases another company in the same line of business. So all those companies now, they fall under Maskani Group of Companies, and they are separate legal entities. So Maskani Developers is able to employ its own staff, right? It's able to enter transactions by its own and so on. Before, those transactions were being dealt with under Maskani Enterprise. So Maskani Enterprise is the one which was hiring. Maskani Enterprise is the one which was doing the reporting. Maskani Enterprise is the one which was paying taxes, etc. But now Maskani Developers and Maskani Property Management, they are hiring by themselves. They are paying taxes by themselves. They are doing reports by themselves, or they are accounting for themselves as separate entities. Okay. So at that point, if Maskani Developers and Maskani Property Management enter into a transaction, then that transaction becomes an intercompany transaction, because that's a transaction between two separate legal entities, right? So I just wanted to make sense of what we've been doing. Now, in our case, we didn't have any legal entities set up, and that is something that Oracle allows us to do also, as we're going to see a situation whereby we have no legal context. Okay. So, and basically, if you're not using other modules such as the EB tax module or the subledger such as receivables and payables, you really don't have to create a legal entity, because once you start creating setting up the payables module, then it means you're transacting with external entities and so on, and the only kind of entity that is allowed to enter into those kind of transactions, then it also has to account itself this way. It has to be a legal entity. So I just wanted us to get an idea of what we are talking about when we say things like legal entity, and now we know the difference between intercompany transaction and versus intracompany transaction. And it all boils down to an intercompany transaction is one that occurs between two legal entities while an intracompany transaction is one that occurs between what? Between two components which are under a single legal entity. So we are going to look at more about intercompany and intracompany. We are going to look at different examples, but for now, let's digest what we have just talked about, and we know now what the meaning of intercompany is and what the meaning of intracompany transactions is. So let's end our lesson there, Bob, unless you have something to add.
Thank you, Victor.
Thank you.